Today, we're going to discuss the customer reserve calculation, which is the process that broker-dealers use to protect customers and funds and separate it from the firm's business funds. What you'll learn: it's going to be the purpose of the customer rule, some common transactions that are included in the formula, the actual reserve formula line items, the back office systems that provide reporting and some of the reports that are created by these systems, and key controls that are over the reserve calculation. But first, a few important notes. This presentation is for educational purposes only. It's not legal advice. Consult the rules, which you can find at the FINRA URL listed here. If you're dealing with new products that are not specifically mentioned, don't ignore them. You have to determine how they will be treated under the rule. All right, let's discuss the cash cycle. Customers start by depositing cash and securities with the firm. Then securities are purchased by either paying in full or on credit. Dividends for both cash and securities might be received, or there might be a reorg or a corporate action that will give them either new securities or cash, or even a combination of both. Eventually, the customer will sell the securities and those funds will be deposited back into the customer's account. So why do we need to track this activity? If the process was just to track fully paid for securities in cash, the reserve calculation would be easy. However, customer cash can be lent to other customers to buy securities. Customer securities can be used to collateralize loans from banks or other broker-dealers. Fails to receive and fails to deliver securities can occur, and securities can be borrowed so customers can short securities. Tracking is needed to verify that a broker-dealer is not making use of excess customer funds generated by this activity, and that any such funds are deposited into a special bank account. So how does the formula work? First of all, you want to sum up all the customer accounts plus any penalty items. And you want to sum any customer-related debits less a 1 to 3% charge. Subtract the debits from the credits. And if the remainder is a net credit, then deposit that amount into the special bank account. However, usually a firm will deposit more than the calculated amount so that a cushion is available in case of errors. Both the customer reserve and the bank dealer proprietary account reserve must be done at the same time. Here are the credit balance line items. Items on the left of this slide are either cash that the customer deposited with the firm, money received using customer securities as loan collateral from banks or other broker-dealers, or situations where the firm has not received the customer securities by settlement date. Items on the right are penalty items and are included when the firm has not resolved back-office issues in a timely manner. Notice that the penalty items are for all customers, non-customers, proprietary accounts, whatever. It's not simply for customers only. Offsetting the credits are customer debits, which are derived from the firm lending funds to customers to buy securities. As you can see, it's a much shorter list. Notice that customer funds deposited at OCC and other clearing agencies for certain securities are included in the debits. So here are some common credit items, and that's cash received from customer wires and ACH deposits, cash received from using customer securities as collateral for loans, fails to receive of customer securities, and the market value of customer securities held as a deposit at OCC. In addition, here are the penalty items as noted before. Note that customer debits must be fully collateralized. If not, then unsecured amounts are deducted from the debits. In addition, extra concentration charges for large customer accounts that make up a large percentage of the firm's customer debits, or for a single security that collateralizes a large number of customer debits. These amounts are deducted from the aggregate debits. The reserve formula gets most of its inputs from the firm's back office system. On the left side of this slide are several commercial back office systems like Beta, Fiserv, or FIS. In addition to the commercial systems, a firm can build its own. These systems track the movement of cash and securities and create the core books and records of the firm. The system will handle accounting and back office operations and more importantly, will manage the security master and the stock record, as well as track possession and control of customer securities. Let's talk about the stock record for a moment, and that's really the foundation of securities reporting. The stock record is a double-entry system for recording security positions by QSIP or security number, and then by account. Most back-office systems will have a series of functions for ease of use. Staff members will complete screens with the buy or sale of a particular security in the customer account. The back-office system will make the double-sided entries and update both cash and securities positions. Stock records are organized by security, and for each security, a list of accounts and the number of shares, either long, meaning owned by the account, or short, meaning location where the shares are held, or either owed to. Customer-related fails, both deliver and receive, as well as stock loans and borrows, are included in the reserve formula. It would be difficult and time-intensive if a firm had to identify each fail and stock loan, stock borrow by customer. The Commission allows firms to use allocations to estimate which fails and stock loans, stock borrows are included in the formula. Let's take a look at the allocation process. This is a high-level view of how the information on a stock record is used to create allocations for inclusion in the customer reserve calculation. Basically, for each security, the accounts are categorized or bucketed, the number of shares are summed by category, then using a predetermined sequence, the left side or longs are paired against the right side or shorts of the security. An easy example would be if customer A had 5 shares long, customer B had 6 shares long, 10 of those shares was held at DTCC, and 1 share was a fail to receive. How this would allocate would probably be customer long versus fail to receive for that 1 share, and then customer long versus DTCC for 10 shares. There are videos offering a more in-depth discussion on the allocation system that can be found on YouTube at FinOp Controller or at my website, rmmilburnconsulting.com. Okay, let's talk about some key controls over the reserve calculation. Generally, you're probably going to have 2 or more finance/operations staff members preparing and reviewing the calculation. The source data should probably be imported or copied directly into the Excel spreadsheet to reduce manual input risk. Operations will supply their information, and finance or other operations staff members will incorporate it into the calculation. Finally, finance, operations, and treasury staff members will meet and discuss the results. Each line item on the reserve calculation will have a threshold balance that will require additional analysis should the balance be greater than the threshold. After all the departments agree, meeting notes and deposit instructions will be distributed. Treasury will execute the instructions, whether it's a deposit or a withdrawal, and finance will retain evidence of the deposit, including timestamps, approvals, any bank confirms, and the workbooks themselves support. Common audit focus areas are going to be completeness, valuation, and mechanical accuracy of the customer credits and debit balances. They will be interested in how the firm treats the suspense accounts and the aged items. Auditors will review fails to receive and fails to deliver, including the valuation, and the same process for stock loan and stock borrows, as well as balances held at OCC. And finally, evidence that the reserve calculation was reviewed, approved, and a timely reserve deposit or withdrawal was made. It's important that the cash suspense accounts are reconciled daily and credit items are researched as quickly as possible. Large credit balances should be reported up the line even before they're resolved. This is especially important if your firm is performing daily reserve calculations. Now, as of June 2026, the rule doesn't cover cryptocurrency or digital assets. The Commission is looking at regulations that would either expand Rule 15c3-3 or write new regulations regarding protection of customer-related cryptocurrencies. If you want to do a deeper dive into any of the customer reserve items, as well as additional broker-dealer, finance, FinOp, or operation topics around the reserve calculation, they can be found at R.M. Milburn Consulting or FinOp Controller channel on YouTube. Thank you, and I hope you have a great rest of your day.